very happy to welcome you to our first webinar of this year, even the first webinar for EFRAG as a whole. And it's financial reporting. And we're going to address with you a quite complex topic, if I'm allowed to say, variable consideration. It's the discussion paper we issued, and I'm not going to say a lot about that because we have Malgorzata, our financial reporting tech member, that is going to introduce that. But we're going to discuss the alternatives to address the current accounting challenges. So my name is Saskia Slomp. I'm the CEO here in EFRAG, and it's a great opportunity to take you through this program. And in the meantime, I think you will have a polling question to test at least if our system is working a little bit, if this end of the system is working. So if you could be so kind to complete that so that we can see who is there in the audience, but also to test if our system is now working, given the problems that you faced in waiting for hearing us. So we have this program for a little bit less than 3 hours now. We will have a presentation of the discussion paper by Malgorzata Matusewicz. She is EFRAG Financial Reporting Tech member and partner at EY. Then we'll have 2 panel discussions. So one is moderated by Michael Fechner. He is our Financial Reporting Board member and manager at Mercedes-Benz Group, their accounting department. And then we have Claes Norberg. Claes is administrative board member. He has been a long-time member of our board, and he is the chair of the BusinessEurope sounding board. I think I forgot to say that actually it's not only EFRAG hosting it today, our webinar, it's also BusinessEurope, and we are very glad to organize it with our member organizations. So very happy that, and we have the profound input of both Michael and Claes, which will give the BusinessEurope flavor to this webinar, but also the business flavor to this webinar, which is very much welcomed. So you will have 2 sessions. Each of them will actually introduce their panelists, and then it will be closed by Chiara. Chiara del Prete, she is actually at present our sustainability reporting tech chair, but has of course been for 4 years our financial reporting tech chair, and the discussion paper has been developed under her supervision and with her input. So she is the most appropriate person to make the close and to make the closing remarks and summarize what you have heard today. So some practical things. So you can put your questions in a box at the bottom of the screen. So we hope that you put it in. Do we have already results of the polling? Are people filling that in so that we can see who is there? So put your questions there. They will then be put to the moderators, and they will decide to raise them. So we very much appreciate if you could do that. So the first item is actually to make you a bit more familiar with our discussion paper. So I'm going to ask Malgorzata Matusewicz, our financial reporting tech member, who has been quite involved in the development of this discussion paper, to take the floor and to present it to you. And we have some slides, which I hope as well that they work. Yes, they can be seen. Can they be seen as well to the public? Okay, so you have all the slides in front of you, and they will be presented by Malgorzata. So Malgorzata, I'm handing over to you. So thank you all for the participants to be there. Thank you all speakers to be there. And you will be appropriately introduced by the moderators of both panels. Malgorzata, the floor is yours.
Thank you, Saskia. Good afternoon, everyone. I'm very happy to present to you the EFRAG's discussion paper on accounting for variable consideration. And I think it's good to start with noting that some refer to the issue covered by this discussion paper as variable and contingent consideration. However, EFRAG considered that contingent consideration is like a subset of variable consideration. So basically, we use the term variable consideration here. Most, if not all, what I will be presenting is included in the discussion paper, but when this is not the case, the views expressed are my own and not those of EFRAG. One more point before we start, just a reminder, I think an important reminder. EFRAG is looking forward to receiving your comments on the questions included in the discussion paper, so please provide your comments before end of May this year. So in the presentation today, we will briefly look at the scope of the discussion paper, and then we'll focus on 2 main issues where diversity arises in practice. So the first issue is when to recognize a liability when variable consideration depends on the purchaser's future actions. And the second issue is when to update the cost measurement of an acquired asset for changes in estimates of variable consideration. And these two issues were discussed in the past by the IFRS Interpretations Committee. However, the committee concluded that the issues were too broad for it to address within the confines of existing IFRS standards, and therefore it decided not to add these issues to its agenda. So starting with the scope of our paper, some points to mention are that the discussion paper only considers how the purchaser and not the seller should account for the variable consideration. Also, variable consideration related to the acquisition of a business covered by IFRS 3 is outside the scope of the paper. And the paper only considers situations under which the purchaser has received the asset for which the variable consideration will have to be paid at a later date. Variable consideration is defined as the possible transfer of additional assets in exchange for a received good or service. So changes in the value of the assets that will have to be transferred is not considered variable consideration. For the liability recognition issue, we focused on IAS 32 and IFRS 9. So we considered scenarios when the variable consideration is to be paid in cash or in another financial instrument. For the measurement of the acquired asset issue, the discussion paper only considers situations where the acquired asset should be measured at cost, not fair value. And finally, it may be judgmental in some cases whether the transaction has substance. The discussion paper assumes that the substance is there because it only considers situations where it has been assessed that a particular asset has been purchased and the consideration for that particular asset is variable. Let's focus now on the liability recognition issue. There may be different views on why divergence exists on when to recognize a liability for variable consideration that depends on the purchaser's future actions. However, similar to the IFRS Interpretations Committee discussions, our discussion paper focuses on different interpretations of IAS 32. On the one hand, some consider that IAS 32 requirements mean that a purchaser should recognize a liability for variable consideration when the purchaser receives the related asset. At that time, it can be argued, the purchaser does not have an unconditional right to avoid paying cash when the purchaser has received the asset. Also, it's argued that as paragraph 25 of IAS 32 states that future revenues, net income, debt-to-equity ratios are beyond the control of the purchaser, a liability should be generally recognized for variable consideration when the purchaser receives the related asset, because it's considered beyond the control of the purchaser to avoid this liability. On the other hand, some consider that the purchaser's future actions are within the control of the purchaser, and therefore a liability should only be recognized with the action triggering the variable payment. And they point to another part of paragraph 25 of IAS 32, which they interpret to mean that if the occurrence or non-occurrence of uncertain future events are within the control of the purchaser, no financial liability exists until the event triggering the variable payment occurs. Given the diversity in practice on this issue, the discussion paper considers whether the ISB's conceptual framework could provide guidance on how requirements on the issue should be by considering the definition of a liability and supporting guidance. However, this guidance is, again, interpreted differently. Namely, there are different views on, first, when the purchaser has duty or responsibility that it has no practical ability to avoid, and second, on what is the relevant past event. So is it when the entity receives the asset or when it performs the activity that triggers the variable payment? And the discussion paper also looks at current IFRS requirements. Most of these do not include special requirements for variability that depends on the purchaser's future actions, and therefore a liability that would depend on the purchaser's future actions would be generally recognized when the related good or service is received. However, under IFRS 16, requirements on variable lease payments in a lease contract that are not in substance fixed payments or nor dependent on an index or rate are different. And for these variable lease payments, no liability is recognized until the action or event that triggers the variable payment occurs. So based on the different interpretations of the guidance included in the conceptual framework, our paper lists two alternatives on when to recognize a liability for variable consideration that depends on the purchaser's future actions. The first alternative is to consider the relevant past event to be when the purchaser obtains control of the related asset and therefore to recognize a liability when the asset is received and the purchaser does not have a practical ability to avoid the payment. The second alternative is to consider the relevant past event to be the action that would trigger the variable consideration. In this case, a liability would be recognized when the purchaser performs the action that would trigger the variable consideration. It's here assumed that when the purchaser has performed that action, it has no practical ability to avoid the payment. The criterion relating to the practical ability to avoid the action is important under Alternative 1 and may also have a role to play under Alternative 2 when determining whether something depends on the purchaser's future actions or not. It's therefore important to know when the purchaser does not have a practical ability to avoid taking an action. And there are, again, differing views on this. And the discussion paper therefore lists and consults on some alternative criteria for assessing when an entity has or does not have the practical ability to avoid a variable payment. The discussion paper assesses the two alternatives for when to recognize a liability for variable consideration against the qualitative characteristics of useful information included in the conceptual framework. For example, under relevance, it is considered whether the alternative results in the same timing for the recognition of liabilities for variable payments, irrespective of whether these variable payments do depend on the purchaser's future actions. If it is assumed that recognizing a liability provides the most useful information for predicting future cash flows, when the variability does not depend on the purchaser's future actions, it seems difficult to find arguments for why it would not also be best to recognize a liability for variable consideration when the variability does depend on the purchaser's future actions. Also, for example, for faithful representation, it is assessed whether the alternatives could result in significant measurement uncertainties. And here, Alternative 1, where you recognize a liability for variable consideration before the event that triggers the variable consideration, would result in a higher measurement uncertainty, as you would have to assess the amount that will eventually be paid. You would have to do that until it's known what the final amount to pay is. So Alternative 1 will also be more costly to apply for preparers than Alternative 2. Now let's move on to the measurement of the acquired asset issue. So when it comes to whether or when the cost of an acquired asset should be updated to reflect changes in estimates of variable consideration, there is also a divergence in practice. This may be because of the lack of explicit requirements on the issue for most cases and because those requirements that do exist are interpreted differently or are even sometimes conflicting. So, for example, some note that IFRS 9 requires that when you measure a financial liability at amortized cost, and you then update this to reflect changes in the expected cash flows, these changes should be normally recognized in profit or loss. Others point to EFRAG 1, which would require the cost of an asset to be updated to reflect changes in the estimate relating to decommissioning, restoration, or a similar liability. To assess whether and when the cost of the acquired asset should be updated, the discussion paper looks at the conceptual framework guidance about what historical cost is. However, this guidance could also be interpreted in different ways. The discussion paper then also considers the definition of cost, including in existing standards, to see whether this would prohibit or require changes in estimates of variable consideration that takes place after the initial recognition of an asset to update the cost of the asset. However, the definition of cost is also interpreted differently. So, for example, some read that definition of cost in existing standards say that you should only consider what is paid at the time of the acquisition. That is, you should never update a cost measure. Others consider that cost should be the amount of cash or cash equivalent eventually paid for an asset. So, without clear directions from the cost definition or the conceptual frameworks guidance on historical cost, we have examined three alternatives in the paper on whether or when subsequent changes in the measurement of a liability should be reflected in the cost of the acquired asset. So, as you can see, the first alternative is to never update the cost. This means that when there is a subsequent change in the estimate of a liability for variable consideration, these changes would be recognized in profit or loss. And this is said to be consistent with current requirements in IFRS 2, IFRS 3, or IFRS 9. The second alternative is to always update the cost of the acquired asset, and this approach could be said to be consistent with how IFRS 15 treats variable consideration from the point of view of the seller. The last alternative is to update the cost in certain circumstances. The discussion paper lists possible criteria which could be somehow combined. So one criterion could be that the cost is updated if the liability for the variable consideration is included in the original cost price. And this criterion would reflect what is the reasoning behind EFRAG 1. Another criterion could be that the measurement is updated if changes in estimates take place before the asset is ready for its intended use. So this criterion may be argued to reflect the requirements in IS 16, that the recognition of costs in the carrying amount of an item of PP&E ceases when the item is in the location and condition necessary for it to be capable of operating in the manner intended by management. A third criterion could be to update the cost if the variable payments are associated with future economic benefits. Such an alternative was considered by the IFRS Interpretations Committee. And finally, the discussion paper lists a criterion under which the cost is updated to the extent that the variable consideration is linked to the initial quality of the asset. This could be said to reflect the thinking that the cost should reflect what you get. So if variable consideration is introduced because there is uncertainty about the quality of what is transferred, the cost should reflect what is, ultimately transferred. So similar to what was done in relation to the liability recognition issue, the discussion paper tries to assess these different alternatives and criteria against the qualitative characteristics included in the conceptual framework. So, for example, when considering whether the alternatives would result in relevant information, emphasis has been put on assessing the impact on profit or loss. It does assess that under what circumstances changes in variable consideration that depends on factors relating to a particular period will be recognized in that period, and if the changes relate to future cash flows expected from the acquired asset, whether the alternative will allow for these changes to be somehow matched with income in the subsequent periods. The alternative under which cost is updated if the variable payments are associated with future economic benefits generally scores well in relation to relevance compared with the other alternatives. However, determining what is associated with future economic benefits to be derived from the asset could be often very subjective, and the approach does therefore not do so well when considering faithful representation, verifiability, and comparability. And just for the end, I would like to add that in addition to discussing the two previous issues, this discussion paper also includes a chapter where it's considered whether a unified set of accounting principles for variable consideration should be developed, or whether it's better to address this issue on a standard by standard basis. So the discussion paper also considers additional complexities that would arise if the scope is broadened beyond the types of transactions considered when dealing with the two previously mentioned issues. The discussion paper outlines high-level advantages and disadvantages of developing unified principles versus standard-by-standard amendments, but there is no view taken on which of these two options would be appropriate. So the discussion paper has a question for constituents specifically on whether the accounting for variable consideration should be based on a unified set of principles or considered standard by standard. So overall, I consider the discussion paper to be an excellent food for thought. So I leave floor to the panelists, and I'm looking forward for an interesting discussion. Thank you for your attention.
Thank you, Malgorzata. Thank you for introducing this, what I think is a complex topic to us, and make it more digestible. So hopefully with examples in the panels, it will become even more digestible. It's not this one. Yeah, open. Okay, I understand. I understand that nobody. It's not our day today. That is clear. We have some technical issues here. I think we should be okay now again. So I was thanking Malgorzata for her presentation and making to us this complex topic a bit more digestible. I have also good news for those that are online and listen to this webinar, that we have decided that the deadline for comments is no longer the 31st of May, but is prolonged till November. So if you think that you need more time to digest this, we have given you this time, and we hope that many of you will react, because it's a complex but a very important topic. So I'm going to hand over to Michael Fechner, who I introduced already, our financial reporting board member, who will moderate the panel that is coming and introduce the panelists. I just want to remind you that we would like to receive your questions, especially for the panel on this topic and on what they discuss. So if you can put that in that box that is... And I have to look at what hand corner of the screen. So it's at the left-hand corner of the screen in the bottom. So if you can type in there whatever you want to know from these people, and you will see that you have a lot of eminent people here, that would be very, very helpful. So, Michael, I hand over to you already. Thanks for doing this. And I hope we will have a fruitful discussion in the panel without technical issues. Thank you.
Thank you very much, Saskia. As for the technical topics, we'll do our best. Before I present all the panelists that we have here today, what are we talking about in this first panel? It's the liability issue. Specifically, when should a company that is the purchaser recognize a liability for a asset that it has already received. To make that a bit more digestible, as Saskia just referred to, there's one example that we want to present. Thank you, Rasmus. And that is a very simple, of course, example, which is a football club which signs a new player for a 4-year contract, and that football club agrees to make payments to the player's former club, in addition to one fixed payment, and that is, in our example, that's 1 million as soon as the player has made 25 appearances, another 200,000 when the player is selected to play for his country, and 25% of its proceeds, of the proceeds when the player is sold to another club. So as you can see in those payment terms, there seems to be a bit of room for the purchaser's future actions. What comes to mind, of course, is whether that player will be playing on the field, whether it will be sold to another club, and so on. Before we dive more into that discussion, let me present to you the set of distinguished panelists that share their views with us today. Please bear in mind that all views that are expressed today are the personal views of the panelists and do not necessarily represent the opinions of the bodies that they represent. I start with Michael Stewart. Michael is the chair of the Accounting Working Party at Accountancy Europe and also a member of the Institute of Chartered Accountants of England and Wales. And in his day job, he's the senior expert of financial reporting at URY and is heading the company's London Accounting Policy Centre. So welcome, Michael.
Thank you.
Next up is Gary Berkowitz. He's a partner at PwC's Global Corporate Reporting Department, and his responsibilities include PwC's global view on financial reporting matters with a focus on the industry, except for the financial industry. And what's especially interesting is he has been involved in the EFRAG 12 topic on payments made by an operator in a service concession arrangement, so quite familiar with the topic of variable consideration. Next up for me is Araceli Mora. She is a full professor in accounting and finance at the University of Valencia in Spain and has already participated in all 3 major accounting regulation research projects that were financed by the EU. She's also an editor of the Spanish Journal of Finance and Accounting for over 10 years and the editor of Accounting in Europe, the journal of the European Accounting Association, where she is also a member to the board, to the scientific committee and the management committee. Then the next panelist that I have, I'm not sure whether she needs an actual introduction. It's Patrina Buchanan, ISB board member since December 22, and a long-standing iconic figure when it comes to IFRS reporting. You've been with the IFRS Foundation for almost 20 years. You have done a lot of projects, too much to name them individually. You have also been working on the management of the Interpretations Committee. And before that, I understand you have a bit of auditing experience with PwC. Last, but certainly not least, on the panel is Serge Patin. He's our vice chair to the EFRAG Financial Reporting Board. He has been a tech member. He has been a member of the EFRAG user panel. And in his real job or real life, one might say, Serge is the financial analyst. He's very active in the field of financial analysis and management, and also those related to domains like valuation. Then I understand Serge is already also teaching for many, many institutions in the field of financial analysis, and he's also an author in the field of bookkeeping, accounting, and IFRS. So let me welcome you all to the first panel. I'm grateful that you are here. I remind again that all the views expressed today are the personal views of the panelists. I invite the audience to ask their questions to the box, which was, I guess, on the left bottom side on your screen. So happy to take all your questions. So with that, I would like to start with the panel and the first question on the topic of when to recognize a liability for variable consideration that depends on the purchaser's future actions would be, what are situations in which these types of issues arise? And can you give us some examples? And I would go to the preparer side and ask Michael Stewart to go first.
Thank you. And I must say, I've really enjoyed reading the discussion paper that EFRAG have put together. I find it to be a very thorough research and analysis of the issue, and an issue that it's certainly one that has challenged me for many years. So I'm delighted to see it being addressed in this way. As to the sort of situations in which this issue arises, well, I can see sort of two principal scenarios, which, although perhaps distinct in theory, in practice, I think can be quite blurred. The first being when the fair value of an asset that's being sold is unknown as at the date of the transaction, and therefore variable consideration allows for more information to be obtained to be able to confirm the transaction's value, the asset's value at the transaction date. The second, though, I think could be where the buyer and the seller agree to share some of the risks and rewards arising from the use of the asset immediately after the transaction date. And those two scenarios, I feel, do overlap to some degree, and therefore bring further complexity to the issue. In terms of some specific scenarios or examples where I've seen this in practice, I'd say certainly the extractives industry being one, and also the pharmaceuticals industry as well, which I think is fairly natural given at the beginning of the life of certain assets in those two industries being one where there is significant uncertainty about the future prospects of these assets which are being bought and sold, and therefore naturally there is hesitancy on the part of both the buyer and the seller to want to lock into a specific fixed price in that transaction and want to see how that asset develops in order to conclude on what the final overall price is going to be.
Thank you very much, Michael. I see you already establishing the link to the asset side, which is obvious, of course. The value of the asset I have just heard a couple of times. Let me hand over to Gary from the auditor's perspective. Do you have any examples that you can share with us?
Yeah, thanks, Michael. And I guess just similar a lot to what Michael Stewart said, to be honest. I think commercially, it's when two parties normally are getting together and there's uncertainty as to the value of the asset, either because its value is dependent on some future action that still needs to happen, or its value will be derived by the amount of usage that the party obtaining the asset's actually going to get. So I think that's pretty similar to what Michael said. And again, I guess the industries that I see this the most commonly is the pharmaceutical space. And again, that's normally linked to the fact that you've got, in often cases, a biotech who's developing some form of compound, and obviously it needs to go through various levels of approval before it can get commercialized. And normally big pharma will get involved before you've confirmed whether or not that compound is ultimately going to be successful and be taken through to commercialization. And so when the parties get together to agree the price, as I mentioned, there's a lot of uncertainty over what the ultimate value will be because it's dependent on some future actions that need to occur. And so that's generally where I see it being applied the most, and it's quite pervasive, and the numbers can be quite material, especially when the compound does make it through to commercialization, because then the numbers start getting pretty big, because then obviously it's going to generate a fair amount of revenue for the corresponding pharmaceutical company. So, and again, I'd actually agree. I hadn't thought about it, but I agree with Michael. Extractives is another one, but in many cases there it's structured like a royalty payment, and we'll get onto the recognition part later and what we actually see in practice. But in most cases, entities are not booking the corresponding asset and liability when it's related to a future type of percentage or royalty, and so you generally don't see the asset. And I didn't automatically think of it as a liability because not many people are recognizing it, but I would agree with what Michael said.
Great, thank you very much. Azali, you're representing the academic sector here today.
Yeah, well, myself, but
So do you have any additional examples for us?
Yeah, I would say that I think there is something has not been said by my previous colleagues, is that in this variable consideration normally emerges when there is information asymmetry between the purchaser and the seller. So the seller knows more about the future performance of the asset than the purchaser, and then they agree about this variable consideration, even if it depends on the action of the purchaser. And going back to the example you gave of the football player, if people remember, there were 3 different components in this variable consideration. The first component was 1 million as soon as the player has made 25 appearances. That depends apparently of the purchaser future actions. The second component, when the player is first selected to play for his country, does not depend on the purchaser's actions. So I think it's out of the scope of our debate. And the third component is a percentage of the selling price if the purchasers decide to sell the player before the end of the contract. And in this case, I think this third component is out of consideration because it's related to a change in the condition of the asset from using it, which is measured at cost, to available for sale. So if and when there are indicators that this is going to happen, then I will change the measurement to fair value, and only then I will recognize the liability linked to this new condition. So in fact, the example we are talking about, focusing on this case, will be this first component, 1 million as soon as the player has made 25 appearances. And I will talk about this case later on.
Thank you very much, Arceli. A very interesting view. And then, Petrina, you have been involved in so many discussions at the IFRS Foundation. Can you share from prior discussions, maybe of the ISB or the Interpretations Committee, what is your experience with variable considerations?
Yeah, I think, Michael, it goes along the lines of confirming what others have said, but I think in terms of examples that came to us, it was very much in the pharma sector, so the drug development progression stage. We have heard some examples from maybe media and broadcasting rights, so where there could be variable consideration associated with, programs being developed or broadcast. Gary will know well the service concession examples that got submitted, so that was where, an operator needed to pay variable concession payments that might be, for example, based on a percentage of toll road receipts, etc. So I think those are the examples that sort of came to us when the questions originally came.
Thank you very much, Petrina. Now that we've talked about the examples, I would like to know what's your view on when such a liability should be recognized. And then I'll also turn to Michael and Gary to ask what is the current practice in their experience of when such a liability is recognized. You just referred to a couple industry examples. But first to Arceli, maybe from an academic perspective, when should such a liability be recognized?
Okay, it's not an easy answer, but in general, I would say that 3 things should be considered: the identification of the past event, the expectation of the occurrence of the payment, and the reliability of the estimation of the payment. That's the theoretical framework. So in relation to which is the past event, I think the substance of the contract should indicate the reason for the variable consideration, to see if this is part of the transaction price or something else. So this first component we were talking about with the example of the football player, this 1 million related with more than 25 appearances, is related with the value in use of the asset, and thus makes sense to have this component as part of the transaction price to mitigate the risk of information asymmetry between the purchaser and the seller related to this future performance on the use of the asset, the so-called adverse selection problem. In this case, when the player is ready to be used to play football, the past event has happened. So normally when the player has been transferred. So once the past event has been identified, then the condition to recognize the liability of 1 million in this case will be first, how likely the expectation of payments is, and second, if the amount can be estimated in a reliable way. if the most likely expectation is to pay this variable of 1 million for using the asset more than 25 matches in this case, and not just because it's the intention of the company, that's not enough. It's because there is no practical ability to avoid this payment without being irrational. Then, in addition, the estimation of the amount can be done in a reliable way. For example, in this case, this is 1 million. Then the liability, in my view, and in this case, must be recognized by the purchasers. And in fact, it is important to highlight that under these circumstances, the seller will have a very likely expectation to receive 1 million, even if it formally depends on the purchaser's future actions. So according to IFRS 15, the seller should recognize the receivable. So it doesn't have sense to think that the purchaser wouldn't recognize a liability for this amount. That's my view.
Okay, you're just referring also to when does the purchaser have a practical ability to avoid making a payment? When's that the case? So we'll dive into that a bit later. Now, from the practice side, I'd hand over to Michael again from his experience as a preparer. When is a liability recognized for variable payments?
Yes, and I think there certainly is some degree of mixed practice, which I think is confirms the importance of discussing this issue. I think predominantly, though, there's maybe more sort of waiting for the events that are within the control of the purchaser to occur. I find it helpful to think in terms of what are the conditions that are both necessary and sufficient in order to establish the liability. It certainly is, in my view, about has the liability, does it exist? Is there that past event that was just mentioned as well? Now, clearly, the contract itself is necessary, but where there are actions that the purchaser can control, then the contract on its own, I'd say, is not sufficient in order to get us to the unavoidable payment of cash to the seller. So for me, it would be a case of looking at what are the events, the conditions, are they in the control of the purchaser? If they are, then until those events occur, then the purchaser is not under the obligation to make those payments. So I would tend to see the liability being recognized as and when those various events occur.
Okay, thank you very much, Michael. Gary, from the auditor's perspective, you have a list of examples already presented. What's your experience? When is such a liability usually recognized? You're on mute. Gary.
Let me take myself off mute. That'll help. Yeah. So I think we've got a question coming later around what our personal views are, but let me kick off with what I see in practice. And I think a lot of it in practice is driven by what folks, I think, in substance believe they are paying for is one of the things that I think preparers are thinking about when they're looking at this. And the other is really a cost benefit or I think a simplicity in reporting. I think is driving it as well, because again, I think it was mentioned by Malgorzata in the tee-up. It's a lot more measurement uncertainty if you try and estimate something, and I think a lot of time preparers feel the cost benefit of trying to do that isn't justified. And so there's almost two pieces to this. Normally, if the payment is a milestone type payment, and I kind of, as I say, keep going back to the pharmaceutical type arrangements, where you haven't yet brought the asset into use, but you're trying to confirm the value of the asset based on future actions that still need to happen. As I say, with the pharmaceutical compound that's being developed, our experience is that preparers will wait until they've made a payment. Once they know that they've made the payment, they will capitalize it. So while it is being prepared to be put into use, you wait until you trigger the events that require the payment to be made or result in the contractual obligation to make the payment. And at that point in time, it's recognized and the corresponding amount is added to the asset. Once the asset gets brought into use and the payments are structured more like a royalty, because then it's kind of saying, as you use this thing and you start deriving benefits, let's share some of that because now we're confirming the value because it's linked to how well we're using it. And again, that's You see that in the pharmaceutical space when there's normally royalty payments, as Michael mentioned. You see that in the extractive space. You see it in entertainment and media with kind of actors being paid royalties based on how well a theatrical production does later. And generally, the practice there is when those payments are made, they again are only recognized when they're made, and when they're made, they're recognized as an expense rather than capitalized, because the logic of, I guess, the common man or person on the street would be like, I'm paying for the use that I just did, so it makes sense to recognize it as an expense. So that's typically what we see. As I'd agree with Michael, there's probably diversity in practice and different options are available, but that's generally what we would see.
All right, thank you very much, Gary. So now, going forward to the alternatives being presented in the discussion paper, and I believe that the audience will see a polling question now to ask for their views. We have two alternatives in the discussion paper. One would be recognize a liability when the purchaser obtains control of the asset and has no practical ability to avoid taking that action that triggers the payment, or when the purchaser performs the action that triggered a variable consideration. And what would be the most useful alternative? What impact on the relevance of information and faithful presentation would you expect from these alternatives? And what could be cured by disclosures? And the first one I'll ask is Serge from the user side. Happy to take your thoughts.
Thank you, Michael. In fact, I'm in the camp of those that do not want to see the variable part on day one in the accounts. And my reason is based on the idea that transactions should faithfully represent what they need to represent. The idea is, in my view, if the purchaser negotiates a fixed price and he signs a contract, then that the fixed price basis then becomes invested capital. And I assume that the price that has been negotiated is based on reasonable assumptions with regard to units to be produced, to be sold, net profits, free cash flows, what have you. Now, if you would recognize a fixed and a variable part in the balance sheet, with a variable liability, of course, as credit entry, it means that you would depreciate, let's say, a kind of overvalued piece of machinery that to measure profitability, you would compare that with, let's say, normal, reasonable net profits and free cash flows. In other words, you're creating a kind of accounting mismatch whereby your asset is overvalued and whereby your results and free cash flows and profitability are normal amounts. So it would incorrectly affect ratios like return on invested capital, etc. So therefore, I think that the variable part should be recognized only when the football player appears 25 times, is selected for national team, etc., etc. So that would be my standpoint. But I agree there's no one size fits all, because the football player is a very tricky example already. I agree with Araceli when she says the three variable components are different in nature. And of course, if you're buying a player for 100 million euros and you say, okay, I need to pay an extra if he makes 25 appearances, the question then is, how sure am I that he will appear 25 times over the next 12 months? Well, professional players now play about 55, 60 matches a year. So there is a reasonable chance that he will play 25 times at least. So there again, you might say that part of the variability can be recognized, because I'm almost certain that a particular player will play at least 25 times in the coming year. Now, a player is not a piece of machinery, but you could apply the same reasoning when you talk about the equipment, property, plant, equipment. When you say, well, how certain am I that that particular machine will produce 20,000 units over the next 12 months? So, summarizing, a variable part, no, unless there is a reasonable certainty that indeed you will have to pay a particular amount because the player will make 25 appearances, because that piece of machinery will produce a minimum of 20,000 pieces in the first year.
Thank you very much, Serge. I understand that you just said unless there is a certain probability that the payment will have to be made. So I'll refer that to our discussion that we will have on when has a practical ability to avoid making that payment. Okay, great. Next, I would ask Asli for your opinion.
Yeah, well, it is in fact the case in which it's very likely that this payment is going to happen. So recognizing a liability of a variable component as this 1 million, when it's highly likely to result in future payments, I think is very relevant to predict future cash flows. If the measurement is reliable, and in this case it is, then it will result in a faithful representation. And in terms of comparability, if it's very likely, I will say that this case of including this 1 million as part of the value of the asset and recognizing the liability will be more comparable with a fixed payment of the total amount than with a fixed payment which is lower, because in this case, the expected cash flows are more similar. They are not the same because the risk is lower. So disclosures, I think, play an important role here. But obviously, it should be analyzed case by case.
Thank you very much, Asli. Next up, I would ask and turn to Gary for his view. Let me just say, me as a preparer myself, already get a bit of sweaty hands when I think about documenting what payment will be highly likely and what not. What's your view from the audit perspective?
Well, I mean, I guess there's two pieces to that, Michael. I guess the one from the audit perspective is it's clearly easier to audit an amount once it's required to be paid. So I guess from an audit cost perspective, and as soon as preparer judgment is involved, there's audit judgment that needs to be applied as well. And so clearly from an audit perspective, there's less cost and less propensity for challenge if we stick to when the amounts are required. I do think, though, that again, from a personal perspective, I actually think that the focus on the liability is maybe a little bit of a red herring. I think, the point is you have a resource. It's no longer an executory contract at the time that the asset has been delivered. I think of the diagram that we had to start with. And so I think there's maybe two pieces to this. That people think of liabilities as a binary decision. You either have a liability or you don't. And I think maybe what's missing is there's subtlety or nuance to different types of liabilities. Some need to be paid regardless of your future actions, and some are dependent on your future actions. And I think that's where we're struggling with this question to begin with. So I think it would be valuable, interested, Serge agrees or disagrees with me, to almost show that for investors, to say, I have an asset, it's a valuable asset. This is its value on the statement of financial position. That is the resource available to deploy to me. The football player is mine today, regardless of how much I'm going to play, and it's valuable. What if it's a superstar footballer? And because you've got him for those 25 appearances that the footballer is in, you're going to rake in a massive amount of additional revenue now because people want to see that footballer. So if I was thinking about it from a credit analyst perspective, they might be interested in what are the contractual payments that have to be made regardless of your future actions. But if I think of an equity analyst, they might be interested in knowing what the resources that you deployed were so that they can match it up to the corresponding revenue that you might have made. And so in my mind, I do think that perhaps what's missing is maybe some kind of hybrid model that reflects the different types of liabilities or attributes that we have. So these are my contractual liabilities that we think of today as our good old IS-32 liabilities. And here are these obligations which are not the same as these other ones. They are dependent on future actions, but there's a corresponding asset whose value doesn't change regardless of how I've structured the payments. So I guess that's personally where I think there might be an alternative solution.
Thank you very much. Michael.
Thank you. Yes. Well, I'm not keen on basing the recognition of a liability on probabilities. I think it either is a liability or it isn't one. It either exists or it doesn't. Probability in measurement, fair enough. I think that is appropriate. So for me, very much a case of if we've not actually done enough yet to trigger that liability, we shouldn't be recognizing it. I would like to throw in, though, for consideration that if the purchase contract contract, though, sets certain obligations, certain performance obligations on the purchaser to do certain things, then if it's contractually obligated to do those things, then I think it's fair enough to assume that it has to do that. It can't avoid it. We have to presume that the purchaser will abide by the terms of the contract, and if there are triggers that arise or variable consideration that arises as a result of the purchaser having to follow those set contractual obligations, then fair enough. I would be happy to accept and recognise a liability in those circumstances.
Thank you very much, Michael. Before I present the polling results, I think Serge indicated he wants to come in on this question.
Yeah, just a short comment. It was an interesting exercise to download a lot of annual reports of European football clubs applying IFRS, wondering how they account for their players. The confronting thing was I was looking at players like free cash flow producing machines, which didn't give me a good feeling. But okay, probably that's what they are. Nonetheless, just to come back on disclosures, I've seen one football club that, of course, discloses how much money they would have to pay in case one player is more successful, in case something else happens. So of course, disclosures can solve a lot of the issues, but that's not on the table for discussion now. And I agree with Michael Stewart saying, look, probability, there's a 25% chance that he will be selected, there's a 50% chance that he will get injured, and there's a 30% chance that he will play 30 games for me. And adding that up all together then gives me a measurement basis. That's not the direction of travel I would take. I would prefer, no.
Thank you very much, Serge. So polling results. The audience has voted very much in favor for recognizing a liability when the purchaser obtains control of the asset and has no practical ability to avoid making the payment. So there's a vast majority for that. Rank 2 would be liability or several liabilities should be recognized when the purchaser obtains control of the asset acquired, and the total amount should mirror the fair value of the asset acquired. So more a mirroring approach here. Thank you very much. That's very interesting. So we'll be moving forward. My next question, and I believe that we do have an additional polling question to complement. Then, as we were talking already around the practical ability to avoid making a payment, which is some sort of a cornerstone of this discussion, the discussion paper lists several indicators or thresholds that could be applied when determining there is a practical ability to avoid making a payment. That is a wide range of thresholds. It starts from an entity would have to cease operations, but if it did so, then it could avoid the payment, or it would have minor, marginal, economically unfavorable consequences for the entity. So there's a wide range. I'll ask the academic first. Arsely, what's your view on these thresholds?
I agree with all of them. I think all of them are indicators that this is happening. Some of them are stronger than others, but I agree with all of them.
Okay, if you want to rank, would you say requiring an entity to, or saying that if an entity, if it would cease all its operations to avoid a payment, so the football club would shut down, even though it's very unlikely that they would do so, there would be, at least to me, would be a strong indicator which would, well, not be economically reasonable.
That's the key point.
Yeah. But it's a good indicator also to discuss, maybe a topic also for ICE 37. Next, I would ask Serge, the thresholds. What's your view?
Yeah, I'm not sure. I wasn't sure. I'm really struggling with these thresholds. I do agree with Araceli. They're all correct as such. But I liked one comment in the DP on its paragraph. I've written that down, 2.26, where they say it's all depends on fact and circumstances given the nature of the relationship or the contract or the asset that's sold or purchased or whatever. So I'm a little, as I was telling you, I agree with all the thresholds, but I'm not sure that we're capturing it properly, that part of the debate.
Okay, thank you very much, Serge. Michael.
Yes, so as I understand it, these are thresholds which, if you crossed a particular threshold, then you might recognize a liability which you wouldn't otherwise recognize. And I suppose I'm not in favor of going down that route. I think you've either met the conditions or you've not met the conditions, and I wouldn't really want to bring the economics into it to say, oh well, because it's going to be economically unfavorable, I'm going to book the liability, even though I've not yet met the conditions that require me to have that liability. So, I mean, I think it's a good range. I think it's a good range of conditions here to think about. As I say, I'd probably be somewhere towards the upper half of it anyway, if I was to have to pick one.
All right, thank you very much. Gary.
Yeah, thanks, Michael. And I think the fact that the previous panelists have maybe struggled a little bit to put their stake in the ground, and some definitely here, I think maybe reinforces the point I was making before, which is I think it's because it's a little bit arbitrary. I think it's because it's a different, you're trying to reflect that these things have a different nature, and saying, well, therefore I'm going to choose this specific threshold, I think is why people are struggling. That's why I say I think it's better to actually explain that these types of liabilities have a different nature to ones that are not dependent on future actions. And then I think it takes the pressure off, well, when would this thing be a binary, the existing liabilities we have? So that's just, I guess, an observation, which I thought was quite interesting based on the fact everyone was struggling a little bit to put their stake in the ground. I do probably also agree, I guess, from an audit perspective, this would be very, very difficult. You know, if you're saying you need to make a judgment now on whether or not you think there'd be a significant unfavorable economic impact to the entity, or to be unfavorable in the context of the acquired asset, I think for both the preparers and the auditors, making that kind of judgment will be incredibly challenging. And I could see how you might get diversity in practice based on the way different people might make that judgment. So again, I think the solution to this is there shouldn't be levels of threshold. There should be a different type of liability potentially. But I guess in my mind, if you were to kind of tell me where would I go to, I would be dropping down to, I guess, the bottom half rather than Michael, because I do think economically, once someone has an asset, once you've been given an asset, you are going to use that asset. Commercially, it wouldn't make any sense not to use the asset. Otherwise, why have you entered into the commercial transaction? And so as a result, it's very likely there's going to be some kind of implicit or outflow. Then it comes into kind of measurement of that.
All right, thank you very much, Gary. The polling results are in and indicate that we're somewhat split. There's one alternative that sticks out, and that is alternative D, when avoiding the variable payment would result in using the acquired asset in a manner that would not reflect the economic purpose of acquiring the asset. So that's you acquired the football player to have him playing for your team and not to sit on the bench. But other than that, my takeaway here is that defining what is a practical ability to avoid making a payment, that will be a tough job. And it may not be a black and white edition. So number 2 is also just seeing the update on the polling question. Now equally weighted is alternative B, when avoiding the variable payment would have a significant unfavorable economic impact on the entity. So we're talking a bit of economic compulsion, my takeaway. So that will be an interesting future discussion also. Let me ask really quickly it could be a bit of a summary statement already, but I'm going to go first with Michael. Would you say the timing of recognition of a liability should be the same as the timing of recognizing a liability for variable payment that depends on the purchaser's future actions should be the same as recognizing the liability of payments that do not depend on the purchase of future actions. First Michael, then Gary.
Okay, I think the terms are different. It's reasonable that the timing and the recognition should be different.
And Gary.
And controversially, I think you should recognize it, but as I've said before, I think what you recognize needs to be reflected or presented differently from those other liabilities. So maybe not a million miles of what Michael's saying, because I think that would still reflect the fact that this is a different type of obligation to contractual ones that don't depend on a future performance. I think Michael's just saying he therefore wouldn't book anything. I'm saying I would book something, but make it clear that it's not the same.
Maybe also something for the measurement side. But given the polling results, that the assets intended use may be a bridge to go towards the fair value of the asset and therefore the purchase price, but we'll have that discussion. So now we're coming more to the cost and complexity side. I would turn to Michael first as the representative for the preparer side. When it comes to complexities and costs that would be associated with the alternatives presented, and can you distinguish that a bit for each alternative?
Well, I think I take by this you mean in terms of recognizing or not recognizing liabilities. I mean, you know, if we look at not just the accounting but the disclosure as well, then I think it could be finely balanced from the point of view of the amount of analysis and assessment that a preparer needs to do, because the information needs to be understood. It needs to be understood, first of all, for internal purposes, for budgeting, what you're going to be paying, cash management purposes. And so it needs to be an assessment internally for operational purposes. And I think whether you are booking the liability or not booking it, but you know, in either case, you need to be giving appropriate disclosures so that a user can understand the variability and the risks and the time periods that are involved in this and the conditions on which this variability is dependent. So I think there's a lot of similarity in the costs of either model. I think where there could be a bit more distinction is having to maybe give more explanation in some circumstances than in others. But maybe that's more for, I'll hold that thought actually till we get onto the asset side of the discussion.
Happy to listen to it. I would turn again to Gary for the cost and complexity when preparing financial information.
Yeah, thanks, Michael. And I think, again, some of it depends on where you go. Clearly, what folks do today in terms of waiting for the payment is the relatively easiest and less costly. I think if people are going to go that route, as some of what Serge and Michael said, I think disclosures can go a long way in still helping users to understand where that complexity is. And from an audit perspective, clearly it's much easier auditing qualitative information when someone's describing the type of risks than if they try and put a number to it when they've tried to include the measurement uncertainty in the number. I do think, though, depending on which of the options you go with, that will depend on how much cost and complexity you go with. As we mentioned in the previous polling question, I think it would be, maybe nightmare is too strong a word, but very, very costly and timely if the thresholds are, I think, any one of those, because I think you get into judgments both for preparers and auditors requiring, first the preparer needs to make the judgment, then the auditor needs to get comfortable, and they need to decide whether or not that's a critical judgment that they're going to have to disclose in the financials. So I do think it can get very costly very quickly. As I say, my proposal of just present it as a different type of liability, I think then it takes a lot of that cost and judgment away, because you're really just trying to say how much it goes into the measurement will then become where the complexity and the time will need to be spent. But again, I think when we get into measurements of liability and how you make updates, there might be some ways in which you can reduce those costs depending on how accurate you need to be on day one versus day two.
And that is the perfect transition to Serge when it comes to what information usefulness, how much precision would you require when assessing that? What are the costs that you would expect and complexity from the user side?
Well, most of the time the users take the numbers for granted, so to speak. So we're not really concerned about how complex it is or how difficult it is for preparers to prepare them. So I don't see any problems for us to digest the numbers, to understand the numbers. But as already said, I think that disclosures ultimately, as the project is developed further, we will have to think about how additional disclosures to make sure that the information is as transparent as possible and as understandable as possible.
Thank you very much, Serge. I also remind that the discussion paper is in a very early stage, but it's providing a lot of food for thought. So that's quite impressive. Thank you so far. When we now look a bit further ahead, otherwise, we're talking about the recognition of a liability, which must be in line, of course, with IFRS guidance, which is then the conceptual framework. And I will ask Petrina first whether you think that there are some parts in the conceptual framework that point us in a particular direction, whether to recognize the liability when the asset is recognized, but the company has still future actions that would affect the payment, or else.
Thank you, Michael. And this is a fascinating topic, and I've been enjoying listening to my fellow panelists talk about it so far. I do think in this first instance, and specifically, Michael, on this first question, I do think that the improvements that were made to the conceptual framework in 2018 do provide a good starting point, I think, for any future project on this. And why would I say that is because what those improvements did was they expanded much more, the definition of an asset, the definition of a liability. It got us to focus very much on rights and obligations in the first instance, and then it also added a bit more about when you might think about recognition, and whether to recognize or not. So it's really sort of chapters 4 and 5 in the conceptual framework. Now, I think that conceptual framework doesn't provide all the answers for this topic. Of course, it wasn't designed to. It's a framework, but I think it potentially does provide quite a good framework to start from. And so why do I say that, and what direction do I think the conceptual framework might lead us into? Well, as I say, I think first of all, you would go to chapter 4 and it would tell you to focus on rights and obligations. And by the way, even when we're talking about the liability here, to me, the conceptual framework even tells you in wondering when you recognize a liability to first of all focus on the rights. And I'll come back to that. It's about the past event. And to me, you can't think about the liability without thinking about the rights, what you've got. And I think most often here, if we are thinking about an exchange transaction, then, as I say, first of all, look at the rights that the entity has received or will receive in the future in exchange for, fixed and variable consideration. And I think importantly to think about, is there just, one right that you've already received up front, or is there possibly more than one right that you might be receiving at different points in time? So, for example, in the sort of the football player example we've got, it may be the case in that one where there might be only one right you're receiving. That's what Araceli mentioned, the right to sort of use the player in a sense, and that's received up front. But maybe some of the pharma examples that come up, you could actually be receiving more than one right. So maybe in this, transaction or agreement, you could have received a right up front to develop that drug a bit more. And then maybe you might get a right at some point later, if particular approvals are received, to then go out and distribute or exploit or sell that drug. And if there are different rights being obtained at different times, that can give you a good indication of when you might recognize the obligation. So in my drug example, if there were 2 different rights obtained at different points in time, of course, you're only thinking about recognizing an obligation where you've already received the right. If there's rights that are in there that you haven't yet received, maybe that right to distribute only at some point in the future, then there wouldn't be any obligation to recognize. So as I say, and why do I keep talking about rights? I think that in the conceptual framework, when we, and others have mentioned the past event that you're looking for, you only have an obligation if you have a past event. And I think what the conceptual framework points to there is saying you have a past event when the entity has already obtained economic benefits and as a consequence will or may have to transfer economic benefits. So it's focusing on the right to work out whether you've obtained economic benefits. So if I've received the right to use something, a player or a drug or an item of PP&E, then I have obtained economic benefits. Whereas, in contrast, if I've only got a right to exchange or get access to something in the future, I won't have received anything today. There won't be an obligation to recognize. Now, if you have received, those economic benefits, and if we take the football player example, then of course you're right to say, and everybody's touched on the question that what the conceptual framework then says, that if there are variable payments, and that's conditional or payable variable based on entities' future actions, then you would have an obligation only if there's no practical ability to avoid taking the actions. And I think you're right. I think there's an interesting discussion in the feedback as well. What does that mean? No practical ability, and is there some threshold, and would we set a threshold? And there, by the way, is somewhere that if the board were to take on a project, of course, we'd need to think about and develop some specific requirements, because the conceptual framework itself doesn't go beyond just talking about no practical ability. I mean, for me personally, and linking into what others have said, is I think we don't want to create some very difficult, complicated threshold assessment. I think almost you want to interpret that to go at one end of the spectrum or the other end of the spectrum. And for me personally, I would say, and especially thinking about exchange transactions and assuming they've been entered into in market terms, I would think you could almost always assume, look, these parties have entered into this for a reason. They know what they're signing up to. They've agreed, that club has agreed to sign that player, assuming he's going to play for at least 25 appearances. And you could almost assume that practical ability to avoid sort of threshold doesn't kick in most exchange transactions that are exchanged on market terms. I think where that might kick in is if there are some more, unusual or extreme terms. But I think for exchange transactions, maybe I would set the threshold so that doesn't, affect the assessment of whether the obligation exists so often. Now, maybe to touch on Sergio's point, that doesn't mean that I think applying the conceptual framework, you're always going to be recognizing liabilities at all times for every form of variable consideration. But I think some of what Serge touched on is thinking about measurement uncertainty and how sure that would be. And I think that's where the conceptual framework would say, well, that would kick in at the next step. So if in step one, you've worked out, yes, I think I have an obligation, past event has happened, I have an obligation. Then your next question is to think about, well, do I think I should recognize that obligation? And potentially if the measurement uncertainty is so extreme that you think that would, take away from recognizing this amount, actually providing sort of relevant information or information that faithfully represents what you've got, then that's where potentially you could reach a conclusion that you're not going to recognize it because of that. But it would be step two.
That's very interesting. Thank you very much, Petrina. And you also, and again, as others, emphasize the link between the asset and the liability here. So that's very interesting and, of course, very true. Let me turn to Arsley. What's your view? From your view, the conceptual framework point towards one or the other alternative?
Yeah, I agree with Petrina. I would say that in general, it does. In fact, my previous arguments have been based on that. And I am very much in favor of having a principle-based system, because there is a lot of evidence showing that the benefits are higher than the cost, even if it makes the life of preparers, auditors, and enforcers more complicated. I understand that. But judgment will be required. Indicators are everywhere, IFRS 9, IFRS 10. So why don't we have to have indicators also for defining practical ability to avoid a payment? I would say that the main problem here is not the conceptual framework, and this is my view, is the high level of inconsistency among the standards, which makes the analogy more difficult to apply in this case. We have to live with some level of inconsistency because all the standards are different process, different needs. So the problem is that I would prefer to see a proper argument for these inconsistencies when they exist. And in my personal view, the standard less helpful in this sense is IFRS 16, the leasing standard, which is inconsistent even with itself. So trying to make the analogy with IFRS 16 is a nightmare. I would prefer to make analogies in these cases, in most cases with IFRS 15. That's my point. By the conceptual framework, everything can be improved, but I think in general it's good enough to guide us to support the arguments to recognize liability.
All right, so taking not a fan of IFRS 16 when used for analogy in these situations. Okay, last but not least, my final question would go to Petrina and say, if we would now take this discussion paper, put it to the ISB, and the ISB were to decide we're going to solve the issue, what would the process look like? How would the IFRS Foundation, the ISB especially, treat it? What other aspects would you think would also need to be considered?
I think for me, Michael, the first thing that I would say is I think we would need to look at this narrowly. We'd need to be very disciplined about scope, because I think there would be a real danger with this topic that if we took it on and we tried to think about it too widely, we'd end up spending lots and lots of time, I suppose, getting into possibly sometimes endless theoretical debates about when we think things should happen, as opposed to really identifying, trying to improve financial reporting where it really needs to be improved. So I suppose my starting point is I would think to actually make meaningful progress to improve financial reporting where it needs. We'd need to, consult with the investor community, get some input on where there is a real sort of gap in the literature today where some improvement is needed, and then try to be disciplined and focus on that. As opposed to sort of opening up all the possible scenarios and opening up all the standards that already address, variable consideration in various ways, even if they look at it a bit differently. I would say, by the way, that this topic, in a sense, is probably going to be already, picked up in a number of other projects. There is already an active project in IS 37 to embed some of the thinking on a definition of a liability in there. There's already a FICE project underway, of course, talking about and trying to add a bit more clarity to, working out whether you're recognizing something or classifying something as liability or equity. Personally, I wouldn't necessarily touch IFRS 3 or IFRS 16 again. I would, focus on filling the gap around acquiring items of PP&E or intangibles where you might have variable consideration. We would, of course, always just need to check that's what often comes up is when we write new standards, how do they interact with other standards? So we need to be very careful, that any new requirements developed, we don't create problems if they're interacting with other standards. But I wouldn't necessarily open up everything. Sorry, before I stop, Araceli, of course, I couldn't help myself that as somebody whose favorite standard is, of course, IFRS 16. I wanted, don't let it be told to anybody, but I actually agree with you in your comments on IFRS 16 in this respect, in that I don't think that when the board developed the requirements in IFRS 16, actually, to me, we didn't have the benefit of, I think, the structure and the conceptual framework now, that we had back then when we were thinking about it. Personally, and I'm very much giving a personal view, I think if we had the structure that was in the conceptual framework now, I'm not necessarily saying the board would have reached a different answer than it did on some of the variable consideration outcomes, but I think we could have articulated better the reason why. And I think that's why I agree with you. I think that because we didn't have the structure in the conceptual framework, and because perhaps we felt that based on the feedback that the board had received, just given the sheer volume of leases, and I would mention that, by the way, because I think it influenced the board's decision making in IFRS 16 a lot. The fact we were aware that you could have individual companies that could have thousands of leases, with pretty substantial variable payments, and also we had, valuable input from investors. The board could reach consensus on saying we won't require entities to recognise liabilities for, those variable payments based, say, in future sales, but it didn't articulate clearly exactly the reason why. And as I say, I think at least for quite a few board members, and if it were me, the reason why might have been measurement uncertainty. It might have not been that there's not an obligation. It might have been, and I think if we had the structure of the conceptual framework, we could now articulate much better the reasons for the decision making.
Very interesting. I'm looking forward to seeing that project also being discussed by the ISB. So before we come to maybe a short run, or does anybody else want to come in on this question on how the ISB should proceed? Otherwise, we have some questions from the audience, which I would like to put to you. And first question is, isn't the likelihood of the transfer rather a question of valuation than a question of recognition? Now, Patrina, you have just already pointed out the conceptual framework requirements. If you would say it was either valuation or recognition, the likelihood of the transfer, where would you pinpoint it? So the probability that a purchaser would need to make future payments. Would you say that's a valuation topic rather than a recognition topic, or both, or something in between?
I think it could be. I think for me and my comments, I wouldn't put the probability into the assessment of whether the obligation exists. So I think that notion of no practical ability, and as we've talked about, I wouldn't set some sort of, I would set a relatively, at least, in the context of thinking about, as say, exchange transactions, we've negotiated this. Hopefully we have some idea why we entered into this contract. I wouldn't set any high threshold at all to not say there's an obligation. So let's say, assuming I've got an economic resource, I've got the rights, I'm going to say there's an obligation unless it's a very extreme situation. But I do think then that, and maybe it's not directly probability, Michael, but I do think then there's a recognition question that might be based on measurement uncertainty. So, for example, and again, if we just assume that in our football example, there is just one right that's being received and it's being received up front. If I think about the third piece of the payment, that 25%, of any future sale that might happen, again, thinking about all the different thoughts, well, presumably if things, go to plan and I've brought this player in and they're doing brilliantly for me, I won't intend to sell them at all in the 4-year contract. I'll want to, get them to sign a new contract. And, so thinking about economically, that piece potentially is not something that I would have thought about happening. And equally, when I would come along at the start of this contract, even if I think there's only one right, I'm probably very likely to say, well, I think there would be so much uncertainty about how I'd even measure that 25%, because who knows when I'd sell it and who knows how much I could, transfer that player on for. I simply, even if I said in theory that an obligation exists, I'm not going to recognize anything because the extent of measurement uncertainty would be so great that I think it really wouldn't provide good information to investors to actually recognize it. So, sorry, Mike, I don't know if I'm answering your question. I think I wouldn't focus so much on probability, but I'd probably think more along the lines of, how certain are you to be able to measure it?
You answered, and I take it that there is no specific answer one can ever give about this topic, because it depends. So, since we're already a bit short of time, let me combine some questions which I would ask Michael and Gary and potentially Serge to come into, if you want. and that is the economics of the purchase or the intention of the purchase. Should they be taken into account? Should we merely reflect it? And Michael, you said it before, should we merely refer to a contract, what is written in the contract, or should the economic of the purchase be taken into account when estimating when a liability is due or when there's no practicable ability to avoid making a payment, connected, of course, with structuring opportunities and therefore being detrimental to comparability and usefulness. Michael, I would just start with you, if that's all right.
Of course, and I would always start off with what are the rights and what are the obligations, and make my assessment from that starting point. I just have a bit of an aversion to trying to override that because of certain perceptions of the economics. Yes, it's important to make sure that we understand the substance, but for me, the substance comes from the rights and obligations, and that would always be my starting point.
All right, thank you very much, Michael. I'm cutting you a bit short because I want to hear Gary's view, if you have one.
Yeah, no, actually, I'd agree with Michael. I think you know, your rights and obligations derive from contractual rights and obligations. I think it's quite a slippery slope to start saying I'm going to infer rights that don't exist, that can't be enforced. You know, and again, from an audit perspective, that's very difficult. You know, and again, when people say, but my intention was X, in a lot of cases, it's very difficult to obtain audit evidence of someone's intention. And I mean, we've seen it from an IFRS 8 perspective, which is one of the more difficult standards to apply exactly because of that, because it's a lot of the time through the eyes of management or management's intention, which makes it auditing of it very difficult. I think that's not to say we don't and we wouldn't, and I think Michael would agree, if someone's just written a contract to achieve an accounting outcome or a structuring outcome, we would look through that, because I think the logic would be we would say there's no substance to those contractual clauses. But I think that's the exception rather than the rule. So I'd probably be in a very similar place to Michael Stewart.
All right. So the intention of a purchase. Serge, Arceli, do you want to come in on that question? That would be the final part of this.
Yeah, I absolutely agree with what Michael and Gary said on this. And it's paragraph 25 of the DP that says you need to take into account the duties and responsibilities of the purchaser. So it's rights and obligations that you consider when deciding upon the accounting agreement. So fully agree with my colleagues there.
All right. Arceli, then it's your last words for this session.
No, it's fine. Thank you.
Okay, great. So then we conclude this first panel on when to recognize the liability. This is the end for me. So let me say thank you to all the panelists. It has been a very interesting discussion, and I'm looking forward to be an observer from now on. And with that, I will hand over to Claes Norberg to moderate the second session. Thank you very much.
Thank you, Michael, for the handover. And I'd also like to take the chance to welcome the panelists for this second session. It's a great pleasure to moderate this when we now move into the second question. And the second question is that whether and when to update the cost measurement of the acquired asset for changes, if there are changes in the estimate of this variable consideration that we're discussing here today, and taking into account also that could also, as we already alluded to in the first session, it could relate to to circumstances which could be in the control of the purchaser, and also could be situations that are not within the control here. So with having said that, just let me immediately kick off with the first question, is that going to discuss that, but well, how is current practice? How is changes in estimates of variable consideration currently accounted for? And maybe Gary would like to start on that one.
Sure, Claes, thanks. And I think I might have alluded to it in the first section, but I think it's some of it depends on what the payment is being made for. As I say, in the pharmaceutical examples, sometimes those variability payments are made before the asset is available for use. And in those cases, folks are generally waiting until the payment is confirmed, and then they capitalize into the value of the asset, because they say this cost's being added to the generating capacity of the asset, and therefore I think it should be capitalized. when you start looking at variable payments which are royalty based, and so in other words, they're based on the use of the asset once it's currently used, in most cases, there's normally not a true up of the variability because it wasn't recognized in the first place. But once it is confirmed, the payment is confirmed, it's generally expensed through the P&L, with the logic, I think, being that folks are saying, well, that payment was for the use of the asset in the preceding period or in the current period, and therefore it doesn't make sense to capitalize it once I'm actually using it.
Thanks. And moving to Michael, what's your view on this from a preparer standpoint?
I'm not sure I could add more than what Gary's already said, because I think, where there are payments made in terms of sort of milestones in development, etc., then that would typically be seen as part of the development of the asset in any case, and part linked to what the future economic benefits are going to be and come from it. But when we're then talking about share or a sharing of results afterwards, then I think that's commonly seen as being part of those operations that the asset is being used in sort of once it's been brought into use.
Okay, thank you. Since this is also a question of there might be divergence in practice today, I think we should also think about what the definition of cost and supporting guidance is of today in the conceptual framework, also regarding the measurement side, and whether you think that the framework points in a particular direction, or whether the cost of the asset should be updated for changes in estimate of variable consideration. And also think about if you consider that other guidance that is in the conceptual framework as of today, including the qualitative characteristics of useful financial information, would that also, apart from definition of cost supporting guidance, would that also point into a particular direction of whether the cost should be updated or not? So maybe I'll give the word first to Artheli.
Well, yes. My answer is yes. I do think the answer is mostly in the conceptual framework. In this case, I would adjust the asset for changes in estimates of variable consideration, and I'm going to argue why. It is important, in my view, to distinguish between two things which are not clear in the discussion paper of the EFRAG, I think. One thing is a change in the estimation of the expected performance or expected cash flow of the asset, so a change in the quality of the asset, that's one thing. And a completely different thing is a change in the estimation of the variable consideration of the transaction price of a contract. Even it might be linked to some way to the quality of the asset or not. And these are completely different things. And we are if we are in the first case, a change in the estimation of expected performance or the expected cash flow of the asset, and we are not, then the historical cost does not reflect changes in value, except those related with impairments, so on. So we were referring to these. If we are referring to these changes, we don't adjust the value of the asset, except for impairment, because we are using historical cost, no current value. But we are not in this case. We are in the second case. We have a change in estimation of the variable consideration of the transaction price of a contract. So we have to adjust the transaction price. It is true that this variable component of the transaction price can be linked to a change in the quality of the asset or with a change in the uncertainty of the initial predictions of payments, but the adjustment of the transaction price is not the same that the adjustment of the value of the asset due to a change in expectation of future performance of the asset. And the transaction price is part of the historical cost. So if we have a change in estimation of the variable component of the transaction price, and the transaction price is part of the historical cost, we must change that cost of the asset accordingly when this change in estimation takes place. And the football player is a very good example to see the difference. For example, imagine we did recognize 1 million, this component of 1 million when 25 appearances takes place. We recognized at the beginning because we had a high expectation to pay, no practical ability to avoid it. Then the quality of the player was good, and we expected to use the player for more than 25 matches. But imagine that sometime later, the player has an injury. It is not expected now that the player plays more than 25 matches anymore. So two different things might be under consideration here. The first thing is there is probably a change in the expectations of future cash flows of the asset. so they are expected to be lower. I would adjust this value because probably there is an impairment, not because of anything else, just because of the impairment. And this is out of the scope of this debate. And the second thing is if there is a change in the estimation of the transaction price. And in this case, there is. The transaction price that I estimated plus 1 million decreases in 1 million because of this variable component. So as the transaction price is part of the historical cost, I must decrease the cost of the asset. So I have to adjust the asset, reducing the historical cost in 1 million. So this second adjustment has nothing to do with the potential impairment of the asset. Imagine now, for example, that the player is going to be much better. So there is an improvement. Again, two things under consideration. The first thing, there is probably a change in the expectation of future cash flows. Yes, they will be higher probably, but I won't adjust its value because we are measuring at cost. We are not using current value. However, what about the second thing? Is there a change in the estimation of the transaction price as a consequence of this? Not in this case, because I will pay 1 million, whatever the number matches, the number of the batches once they are over 25. But so there is no change in the variable consideration here of the price. But imagine a different situation in which it is 1 million between 25 and 40 and another million more than 40. And this change in the quality of the assets makes me to pay 1 more million. In that case, I will increase the value of the asset in 1 million because of this change in expectations of the transaction price. So again, these adjustments will be something different and independent on the potential change in the future cash flows of the asset, which won't be considered. So the key point is to have very clear we are not adjusting the value of the asset, we are adjusting the transaction price of the contract, which is part of the historical cost of the asset. And by analogy, this is very clear in IFRS 15. In IFRS 15 is very well defined, and in the same circumstances, the seller will be adjusting the transaction price. So I think in general, the conceptual framework and this analogy drive us to this direction. And I miss this analysis in the discussion paper, I have to say.
Okay, thank you, Araceli. Moving to Patrina then, what's your take on this from a conceptual framework standpoint?
I think, Araceli, I think I'm not as positive about what's in this conceptual framework as you are in this specific respect. And don't get me wrong, by the way, I do think, so compared to the first question, as I say, I explained why in the first question I thought the conceptual framework itself provided, in my view, a very good framework. I do think that in the context of measurement, there's obviously less in the conceptual framework on measurement than there was on, definitions and recognition. And I do think where the conceptual framework should be very helpful to us as a board in measurement is perhaps thinking about which measurement basis to use, to go for a current value measurement or a cost-based measurement, what makes most sense, thinking about those qualitative characteristics of useful information. But actually, when we assume that it is measured at cost, as we do in this case, it perhaps to me doesn't give us a very strong direction about, updating the cost, the conceptual framework itself. So I think you're right, Araceli, potentially in other standards like IFRS 15, there's some of it has been developed. So, but again, so I think if we were to take on a project on this, we'd need to, take what's in the framework, but think about developing more specific requirements around it. And I think maybe what I'd say that in terms of things we might need to think about, a lot of it lines up with what you said. Araceli, I come back to my first part again and I say, well, one question is really maybe slicing and dicing the rights, appropriately and thinking about when you come along and there's either an update to the measurement of a liability for variable consideration, or, you're now anyway at some point recognizing that liability or the first question is, do I think anything's changed in terms of the rights I've got, the bundle of rights I've got? So if it's again, back to first example, if it's an example where a payment becomes, or consideration becomes payable on a milestone on something happening, identifying if whether actually at that point, the entity now gets something new or something different in terms of the rights it had, might tell you about whether that's why you initially didn't recognize some of that consideration as a liability, and now there's a point that says that bundle of rights that's represented by the asset or embedded in the asset, has that changed? And therefore, does it make sense that I would, adjust even the cost-based measurement of that asset because what the bundle of rights that's embedded in that asset has now changed because there's an extra right that's in there. I do think, and maybe I'm jumping around, that obviously in thinking more holistically from a cost-benefit perspective, there also might be a question about whether the liability gets remeasured at all. And I do think that in thinking about whether the liability gets remeasured, that could be very much influenced by what the initial measurement has been. So if a liability has been measured, how has it been measured? And if potentially, again, if I think about an exchange transaction at market terms, and if the asset and liability being recognized, was based on that transaction price is close to a fair value, then you might think, well, that then is potentially representing, that exchange transaction. It's reflecting the asset and liability that's been exchanged at that date, based on how these two parties have negotiated the pricing and what's reflected in there. And if initially I've measured, the asset and liability in that basis, of course that might then the ultimate consideration might change, the value might change, but I might say either from a cost benefit perspective, I don't think I need to update the measurement. Let's not make preparers do that, even though in the ideal world I might, but it's not going to be that far off. I won't make people do all that tracking and remeasuring. Or there perhaps could be an argument that says, if I think that, thinking about whether I should adjust the asset or not, if I think the asset was already reflected based on its fair value, in the exchange contract, then maybe I shouldn't update it. If there's any movement in the liability, that's just something that's happened as a result of some change in the period. And I don't think it would be appropriate to update the asset. I think alternatively, along the lines of what Araceli said, I think there also are potentially good arguments to say why you might update the measurement of the asset if you've got, a change in estimate of the liability, and therefore you might say a change in what you've actually paid for the asset. So if this is a cost-based measurement is supposed to reflect what you paid for the asset, does it make sense to update that estimate of what's paid? And I suppose I think the rationale, if you look at the rationale behind, for example, what's in EFRAG 1 about decommissioning obligations and that piece of the cost of an asset that's represented by those decommissioning costs. Also very much within leases, when we thought about lease payments that are inflation linked, I think in both of those cases, the thinking was very much what's included in the initial, cost measurement of the asset is an estimate. And it seems appropriate that if that estimate changes, we should update the estimate of the original estimate of cost to almost be a better cost measurement. But as I say, I could see arguments from some others that might say, if I think that the measurement that I've got at the start is really reflecting the exchange transaction and what I've got at that date, there may be an argument to say we don't.
Thank you very much, Araceli and Patrina. And with this interesting reflections on the topic, let's move to the users and preparers and auditors then and say that what do you think would be, if you look into the discussion papers on the alternatives are considered there regarding remeasurement of the assets, and one alternative, of course, it should never be updated. The other one is, of course, the binary one. It should always be updated. And the third one is, well, it depends on circumstances if it should be updated or not, and that can also be further developed. So it would be interesting to hear from starting with Serge, what you think would be the most useful information given those alternatives that we are there.
I think the most useful information is to update the book value of the price at which the asset is recognized in your balance sheet, for simple reasons. If at the start you think you're buying a machine for 100 million euros under normal circumstances, blah blah blah, and then for some strange reason the player or the piece of machinery is more successful, more profitable than expected, and you have to pay an extra amount of money 1 or 2 years later, then it's quite clear you haven't bought the piece of machinery for 100 million, but you have bought it for, let's say, 120 million. So, and that capital invested is the crucial amount that you want to see appear on the balance sheet. So, of course, if 1 or 2 years later you have to pay an extra amount, depreciation schemes will be adjusted, okay, and will compensate, of course, the more profitable business in which you're now involved. So it seems logic to me that you adjust the amount of capital invested to make sure that you faithfully portray what has actually happened with that specific investment. So debit the asset, credit the cash, or if you adjust the variable the variable liability, the same. I mean, debit the asset and credit the liability. Having said that, there is one. So that would be my most logic standpoint. Having said that, I've seen one example in the DP which contradicts my thesis. It's saying the example there is. Once you're selling more than 10,000 units for 10 euros per unit, then you have to pay the original seller €1. So I think if there is a clear relationship, very clear, that part of the sales price then goes to the original seller of the asset, then I started to doubt, probably that should then be accounted for in P&L, of course, because I'm not selling, if I'm selling my a unit for 10 euros, I have to give 1 unit to the €1 to the original seller. So that seems to be, as in nature, that seems to be a totally different situation. In that particular case, I think that that should be recognized in P&L, I think. So it becomes a more complicated again than I thought it would be. But initially, my standpoint would be adjust the book value of the asset, and that leads then to different amortization schemes going forward to reflect as good as possible the profitability of the investment.
Thanks, Serge. Moving to Michael, from a preparer perspective.
Thank you.
What do you think?
Yeah. I would go for what I think is alternative 3D in the discussion paper. So adjusting the cost of the asset when the variable consideration is linked to the initial quality of the asset. And with that, I go back to where I started, which was, needing to assess whether what is the variable consideration for? Is it about the uncertainty associated with the asset, or is it about the sharing of risks and rewards from the activity in which the asset is being used subsequently? And so to the extent that there is sharing of risks and rewards, and these payments are to do with that, then I don't see why there is a justification for adding to the cost of the asset in these cases. And the longer you move beyond the transaction date, then the further and the more distant you're going to be from that original quality of the asset. You're going to be impacted by so many things. So the general economic development environment, changes in market prices, other inputs that the purchaser is applying with the asset to generate these economic benefits, all have a part to play. So in our football example, as you move through the season, so the performance of that individual player is affected more and more by the other players who are on the pitch. It isn't just one player, it's a whole team of players, and they all impact the relative abilities of each other and the success of the team overall. So I really think that it's important to come back to, well, if it's about the initial quality of the assets, giving us more information about that, fair enough. But otherwise, no, I wouldn't add to the cost of the asset.
Thanks. And moving to Gary then, from your perspective, would you go along those lines that Michael have, or have you a different view?
Well, I think some of it is in the eye of the beholder. And I think Petrina summed it up nicely. You know, there's the kind of the IFRS 3 view of it, which is what was the meeting of the minds best value that we agreed on at the date we entered into this arrangement, and thereafter it's things that changed beyond what we knew at the time, and that was the best assumption of cost. So kind of an IFRS 3 view, or there's kind of an EFRAG 1 view, which is this is my best estimate as the entity of the cost, but that cost might have been wrong on day one, and I might need to true it up if more information tells me that it's a change in the estimate. So I think some of it is personal preference. I'm more of a old school kind of EFRAG 1 kind of guy, and I think that's similar to what kind of some of what Serge is saying. So I'd probably be on the it depends side. And the reason why I say I think I'd be in the kind of alternative 3, which is it should be updated in some cases, because I do think it does depend on when you update your estimate of the cost, are you updating it based on things that you've already got the benefit from already, or is it things that you're going to get a benefit in the future for? And I think if you kind of think of the football player as the example, let's assume for whatever reason on day one, you didn't think that they were going to be there for 25 appearances. And so you didn't book a liability, you didn't book an asset. The person's now been there for 20 appearances, and you think, you know what, actually, I think they will be there for 25 appearances. So the amount I'm going to pay for this player has gone up. But the reality is that some of the benefit that you're going to get for that cost has already been incurred when he played his first 20 matches, and some of it's going to be a benefit for the remaining number of matches that he's going to play. And so I do think what, in my mind, would make the most amount of sense is an apportionment of that kind of update, and some of it is for future benefits, which should be capitalized, but some actually relates to past activity or past benefits that have already been consumed. You're just saying, I now know what the cost of the consumption was. So I do think it's kind of where the committee was thinking about EFRAG 1 originally, but ultimately landed on what we do. I think if you go to the basis for EFRAG 1, there was some of that discussion in there. That's at least where I would be.
Thanks. And moving then to think about cost complexities and costs for preparers. We're thinking about those different alternatives. So turning back to Michael again, so say what are you thinking about cost complexities?
Indeed, and there are, I mean, clearly re-estimating values brings its complexities and its costs from actually going through that. I think where costs are being added to the asset, then it potentially increases the risk of impairment being needed, and therefore there's the additional costs associated with impairment testing that might come along with that. On the other hand, if all of the adjustments are being taken to profit or loss, then the preparer may find themselves having to explain the impact of these amounts on the profits for the company, and may even lead it towards preparing a non-GAAP measure in order to help explain those impact on results. So there's complexities and costs on both sides, and so depending on which one you take, you've got different complexities and different costs.
Thanks. And moving to Gary also on that one.
Yeah, Claes, I probably agree with Michael. I think the costs are and the complexity will come in depending on where you made your decisions along the way. I mean, clearly, if you said, I'm going to wait until the variability is confirmed and then I'm always going to update the value of the asset, it creates a question around impairment. But I know, for example, when you have lumpy milestone payments, sometimes in the pharma space, that's what they do. But it's just luckily, normally the future benefits you're going to get means that there isn't an impairment to book. But that does seem to be a relatively simpler solution than what I proposed would be my solution would be probably quite difficult from a cost perspective in terms of doing that apportionment. And I think that was some of the reason why the committee landed in the EFRAG 1 approach of saying, just do it prospectively and test for impairment, because that was exactly some of the cost benefit discussion that went on at the time. Again, as I say, I think if you make your best estimate on day one, there's cost involved doing that. But then if you take all subsequent changes through P&L, you don't have to try and worry about the apportionment or whatever. And it's really just updating for when the payment gets made is easier. So that's a very long way of saying I think it's similar to Michael. I think there's pros and cons both in the informational value, but in the cost benefit for any of the options. And I don't think there's a best scenario that otherwise we wouldn't have been debating this, and EFRAG wouldn't have written a very good discussion paper.
Yeah, thanks. Serge also want to come in on this question. Please, Serge.
Yeah, to go back on Mark, I agree with you, Mark. Indeed, it's I would say we adjust the cost price of the investment. That's clear. But of course, that doesn't mean that afterwards you have to probably revise the way you depreciate that asset or amortize the investment. And of course, it doesn't mean you don't have to test for impairment. It's a little bit of contradiction because you're paying more because most likely the asset is more profitable than you had expected, than you had foreseen, or than is foreseen in the contract. And on the other hand, you would test for impairment. So that doesn't sound right. But it can't be excluded that you debit your asset and at the same time need to test for impairment and book an impairment charge. It could happen.
Thanks very much. And now we are also launching our last poll of today. There are actually two parts of this poll, 4 and 5. And the first poll is poll 4, and where we ask the audience to give their views on the alternatives that we're discussing here today. And alternative 1 is that we should never update the cost of the asset. Alternative 2 is it should always be updated. And alternative 3 is should be updated under some circumstances. And on poll 5, you will find the sub-alternatives on alternative 3, it's updated under some circumstances. And the first one is to say that when estimates of variable consideration are included in the asset cost at initial recognition. 2 is to change an estimate of variable consideration takes place before the asset is ready for intended use. The third alternative is when variable payments are associated with future economic benefits to be derived from the asset. And 4 is when variable consideration is linked to the initial quality of the assets, as alluded to before by Michael, for example. And the 5th option is other ones that you can think about. So please go ahead and make your vote on the poll. And while you're doing that, let's move to back to Petrina to take the standard setters view on this. So Petrina, a question for you is what would be the standard setting complexities for you that would want to provide some requirements, whether and when changing the liability for variable consideration should be reflected in cost of the acquired assets. And as you already alluded to, the framework does not provide a great deal of maybe a direction on this, but it'd be interesting to hear your views on that if you would pick up a project in theory.
Yeah, I think it's a good question, Claes, and I think that the discussion to date on this, by the way, probably explains what the complexities would be in a sense. But I suppose for me, even if we start from my earlier comment, which is, I think in this topic, let's keep it narrow. And when I say narrow, focus on items of PP&E and intangibles where there's variable consideration. Even within that, I think the discussion, today illustrates that still there's such a variety of different types of transactions that would fit into that. So not only different, rights that you're getting, but different forms of consideration, different reasons why, parts of the consideration might be variable, kicking in at different points. Any conversation in this, of course, you're first of all thinking about the rights and obligations, but then you're also overlaying recognition requirements and measurement uncertainty. And then on top of that, you've got cost benefit considerations. You need to think about initial measurement, obviously then to get onto subsequent measurement and whether that should affect the asset or not. So I suppose, and for me, even in saying we should keep it narrow, it would mean covering off and thinking about so many different important aspects. I suppose I think that's where, and that's why, and by the way, I should have mentioned, Claes, as well, in thinking about that, then in developing any new requirements to cover this area, we'd need to try and ensure they fit in and don't create clashes with the other requirements that are already sitting in, the PP&E standard, the intangible standard, et cetera, et cetera. So I think that I come back and say if we were to take on something in this, I think discipline would be important, discipline to stay focused, just to try and work through each step without getting distracted and going off into lots of different directions.
Thanks. Just a reminder for the audience that in order to get to question by poll 5, you have to scroll down on the page. So just a reminder of that. So you do that. I also want to let Serge in on this question. So please, Serge.
I was just, Claes, could you respond to this? I was just responding to Rasmus. Could you please repeat your question?
Yeah, you raised your hand, so you wanted to get into.
Oh no, sorry.
Okay.
No, I didn't. My hand was still there from our previous
Okay, it was an old hand. Okay, great, thanks. So now we're just waiting to get the results from the poll. Why are we waiting for that? Please, Gary, want to interlude?
Yeah, thanks, Claes. And I guess it's a point that I'm not sure if it's come up, but maybe it is linked to the complexities, because I do think, for example, if folks, if you do want to try and measure something on day one, and then the question around how you measure it, because you've been bandying things around like just the price paid or fair value. But I do think, there's a question around whether or not fair value is the right way to think about it, because sometimes fair value, and as we thought about, when the board developed IFRS 15, it might not always be the best answer when you've got binary outcomes. So, if we think about the player example, when you've got very definitive lumpy one-off payments that need to be made, and you say there's a 50% chance we're going to meet that and a 50% chance we're not going to meet it, unless you're a true fair value fundi and you think, well, the 50% times the probability is the arm's length price you would have paid if it was a fixed price. The reality is it's either going to be 0 or 100. And I do think, if there is that type of discussion, there should really be a question around, is fair value the only way to think about it, or should it be more of a best estimate approach where you need to think more carefully around what the different outcomes might be linked to the variability? So I think some of the complexity and some of the stuff Petrina was talking about, there's loads of different things that I think need to be considered before you can maybe land on a day one amount of recognition, but also how it's updated on day two.
Yeah, I agree.
Thanks. And just a reminder for the audience, while you're also filling out the polling questions, that you can remind that you can also write questions for the panelists, but we'll come back to in the final discussion here. Just to remind you that you can always pose questions to that. So with that, we're now eagerly awaiting the results from the polling questions. Let's see if we have something here. Yeah. We have the results from the, I think it's this poll 5 first. I would like to see the first question that we raised, which was the 3 main alternatives: never, always, or it depends. Yeah, thanks. What we see here is a clear preference for alternative 3. It depends under some circumstances. Let's move to the second one. Well, there's this difference here. We can clearly see that alternative B, when a change in estimate variable consideration takes place before the asset is intended for intended use, there's no support for that. But the majority here is for C, when variable payments are associated with future economic benefits to be derived from the asset. And the other 3 alternatives, there's a split on that, roughly equal answers to that one. But that's kind of interesting. So let's go back to the panel to open up the floor for comments on that. That seems to be a preference for alternative C. Maybe I would like to give Serge the first go on to comment on that results of the poll. If you.
Well, I agree with the results of the poll. So I think that's the most logical way to go. Again, referring to the conceptual framework, and it all depends on the context, responsibilities, duties, relationship between buyer and seller. So the example, as I said earlier on, the example that I found in the DP, it was quite clear that the adjustments there had to go through P&L. Because of the circumstances. Each time you sell a unit for 10 euros, you give me €1. So that, and on the other hand, if if you pay an extra amount of money, a variable amount of money, because after 2 years you've produced 50,000 units, okay, that's clearly an adjustment of the cost price of the investment. So it depends. My preference goes to adjust the book value of the asset that you have bought years ago. But depending on circumstances, it might well be that I adjust in P&L.
Great, thanks. Turning to Michael, I think if I recall correct, you were more towards alternative D, but yes, keen to hear your reaction.
That's right. And my reason for preferring alternative D over C is because I think as you move further away from that initial day one, then you've got more factors coming into play that affect the results that might be being generated through the use of the assets. So are we talking about, there's future economic benefits, not because of the asset itself, but because of changes in the economic environment that have nothing to do with the company? It's just, we're in maybe a more growing market, and therefore we're expecting more economic benefits. What has that got to do with the asset? Why should I be loading more costs on the asset in that case when the payments are not reflective of the asset, but of the way in which the asset is being used and the environment in which it's operating?
Thank you. And Gary, from an auditor perspective, and also coming back from the EFRAG 1 discussions here, what are your thoughts on the polling results regarding this alternative?
I mean, I'm very happy with the polling results. I think that was kind of where I was. So thank you, people who are participants. Looks like people are old school like me. But I agree with what Michael's saying, and as I reflected before, I think that is some of the logic that sits in IFRS 3 around look after the business combination. When this thing changes, it's probably linked to changes that are linked to how you're running the business in the future rather than the initial price you're paying, which is why we only have the kind of 1 year. And even within that 1 year, you need to make sure that it relates to conditions of assets at the time. So that's very, it's definitely a good argument. I think the response I would have to that is, I agree, but in my mind, I'm not that fussed around why the price is changing. The reality is that the cost that I have to pay to have this asset has changed. And I guess for folks who are there, you're less fussed around why that is happening. You're more just trying to say, ultimately, this is how much I had to pay for that investment or the cost, which I think is what Serge was saying. I guess from an audit perspective, clearly it's more difficult if you need to try and do a split and an analysis between the payments. I guess, again, it's easier once you have to make the payment, once it's been triggered. So from that perspective, not too difficult to audit. I do think there's more, as I mentioned before, complexity and difficulty in getting that split right. If you do want to try and allocate the adjustment to the amount that relates to benefits that have already been consumed versus benefits in the future. But it's not, I think there's more difficult audit judgments we need to make on some of the discussions we've had before if you start building in thresholds around the liability than this one. So I think this one's the more easily bit of the audited bit.
Thank you. And Araceli, what are your thoughts on this polling result?
I think I also agree with this, but I would add that only if this change comes from a change in the transaction price. So only if the change in the quality of the asset.
You're on mute, Araceli.
Sorry. I just was saying that I would agree with this option, but just adding that related with the quality of the asset, if this change changes the transaction price, not because of the consequence of the change of adjusting the asset wouldn't be the change in the quality of the asset, it would be the change in the transaction price as a consequence of the quality of the asset. It has not been asked by that, but so I agree with this if we can add this to the.
Yeah, thank you very much. Before I will give the floor to Patrina, also, Serge, I have a short comment also.
Yeah, I agree with the fact that we refer to the quality of the asset. But when you say quality of the asset, it means impairment, value in use, fair value. I mean, of course, and we that has to be taken into account, absolutely. But the fact that you've paid an extra variable amount adds to the cost of the asset, and then you test for impairment. As I said earlier on, it seems like a kind of contradiction. You pay more for the same asset, and at the same time you would impair because value in use has come down. But it could happen. But I agree with this reference that we make to the quality of the asset.
Yeah, thanks. And lastly, moving to Katrina, how do you feel about your comments on this polling result? Would this be something, this alternative, could it be something to work on?
I mean, I think it's interesting food for thought and by the way, supported by, comments made by my fellow panelists today. I think it would be, if we take on a project, it's interesting to think about, because I think what's come across in the discussion is, again, it comes back to thinking about, the nature of the payments and what they do. And I think if we were to take on a project, we'd need to think about that, wouldn't we? And see whether if there is a line to be drawn about when you update the measurement of the asset and when you don't, is there a sensible line to be drawn? Because when you look at what's going on, the nature of that update and the measurement, or of what's being paid, there's something different about it in some cases versus others. But I think an interesting food for thought.
Thank you very much. And now let's move to questions from the audience. We have gotten some questions in. And the first question is for Araceli, I think. And the question is that the approach that you are proposing, is that similar to the requirements in IFRS 3? Is that the line of thinking that you have?
I don't think so. I think IFRS 3 is treating something quite different to the contract, for example, of the football player. So I wouldn't pay attention to IFRS 3 for an analogy. I obviously would pay attention to IFRS 15, which is the other side of the contract. That's my guide when I have adapt. No, IFRS 3, I think, is quite different.
Yeah, thank you very much. And the next question is for Katrina. And the question is that, is there a conceptual reason why the discussion on the purchase of PPE, which is IFRS 16 and in tandem with IAS 38, isn't broader to all cases in which an asset is purchased initial measured cost, for example, investment properties, which is then IAS 40? Could the findings on the discussion paper be transferred to such transaction also? So that would be a question for Katrina.
Yeah, no, I think a good question. I would agree that I would think if the board were to take on and look at items of PP&E, intangibles where you've got variable consideration, that would naturally need to extend and cover investment property in the same situation. If only, by the way, because in IAS 40, it both says that you initially measure all investment property at cost. And in fact, then if you choose to measure your investment property at cost, assuming that we're talking about, something that's not a right of use asset or whatever, it actually points you, it sends you to the requirements in IAS 16 to apply your cost model. So yeah, any change we'd make around items of PP&E would certainly also, I think, apply to investment property in the same situation.
Thank you very much. Gary, please.
Yeah, Claes, I'll just maybe reiterate a point that Katrina made, which I think it would be, I think though similarly though, if the board picked it up, this thing can explode very quickly and it can go nowhere very quickly. I mean, I was just, as you said, just looking at concession arrangements and payments from a concession to the operator, we couldn't even get an answer in the scope of IFRAG 12. So I think to the point Katrina made, yes, you could apply this to leases, you could apply it to pretty much business combinations if you wanted to revise IFRS 3, but I just think the bigger you expand the scope, the less chance there is of actually succeeding in making changes. So that's just, I'm reiterating something Katrina said, which I wholeheartedly agree with.
Everyone that's had an experience in standard setting or trying to come up with a specific answer to a specific question would recognize that one. Yes, I can certainly understand that. I have a question for Serge, and the question is that from a user's perspective, how important do you think it is to avoid big fluctuations in profit and loss resulting from changes in estimate of variable consideration? For example, even if changes in estimates of variable consideration does not relate to future economic benefits, could there be some advantages of capitalizing the changes so that they are allocated over depreciation amortization periods, and unless it's impaired? So is there a case to say make it simpler to put it into capitalization instead of having fluctuations? Would that be something for you?
I think
for you?
No. it would seem it's rather illogical that you would have big fluctuations in P&L because you're systematically revising your estimates as to this variable element of the transaction price. So from my perspective, it would make more sense. But then the question is, where do we draw the line? It would make more sense to adjust the amount in the cost of the asset, and then of course you depreciate another amount, you revise your depreciation methodology based on a recoverable amount and useful period, etc., and residual value. So that makes more sense indeed.
Thank you. Gary, please.
Yeah, thanks. And maybe I'm about to get a valuation lesson for free here from Serge, but I mean, when I dealt with some users over the years, I mean, I always thought that the mantra was the trend is your friend. And so I get what you're saying about the fluctuations, but wouldn't it also be, if we go back to our player example, you may have been earning a massive amount of revenue while you've had this valuable player, but I wasn't picking up the related cost because it was linked to a variable payment. That gets triggered sometime in the future. Now, if it's all prospective, it's going to look like in the next couple of periods, actually, I'm performing much worse than I did 3 periods ago. But that's actually got nothing to do with the way I'm running my business. It's got nothing to do with business decisions I've made. It's just all because the accounting has made it all prospective. So just listening to what you're saying and maybe reflecting on this question, wouldn't the best answer be you actually go and you adjust it retrospectively? So it hits retained earnings, but at least then from an analyst perspective, you could update your modeling to say this is what it should always have looked like if I want to compare like with like.
Sympathy for your question, because I was thinking about the football player. The idea is if you pay an extra amount of money because he played his 25th match for your team this year. The question is, when did you start to generate extra revenues when you hired the player? That's a difficult one. It's not after 6 months when he plays his 26th game. So I started with matching between performance and financial position. It's very important, return on assets and how profitable are my investments. But to get that matched perfectly is a very difficult one. I absolutely agree, because you might say I will attract sponsors and merchandisers and more spectators, and I will sell more tickets as of day one, not when the player has played his 25th game. So that's absolutely something to consider when developing this project further. Absolutely right.
Thanks very much. I have another question, and I will read the question first and then leave it open to the panel who wants to jump into this. From the discussion, it seems that we're mostly talking about variable consideration as being an additional amount. What about the other side of it? What about trade discounts? Does it matter in which direction the variability goes for your answers? So that's the other way around, because I think we have talked mostly about paying additional cash here. So anyone who wants to pick up on that one? Michael.
Yes, I'd say that in practice, it tends to be greater amounts that are being paid. It starts off with the purchaser agreeing to pay a smaller amount initially, and then more dependent on success or milestones, etc. So I think that's just the nature of the uncertainty around the value of the asset, that it tends to start at the lower point and then move upwards. I agree, though, that any sort of accounting solution needs to be able to deal with both. So it should also be able to deal with variations that have a refund of the purchase consideration back to the seller, back to the purchaser. So it needs to deal with both of those. The mention in the question related to trade discounts, and there is guidance specifically on trade discounts for things like inventory, etc. So I think that is taken care of. But in principle, I think we need to be talking about both upside and downside.
Thanks, Michael. Gary, you had your hand up, but maybe you just agree.
Yeah, I didn't really have anything to add after Michael kind of jumped in, to be honest. So I took the hand down, yeah.
Okay, fine. Anyone else on that? Otherwise, I want to go back to Artheli. There's a question here for you, is that your idea here to distinguish between changes related to the transaction price and those that are not. I think the question there, can you elaborate a little bit how you would do that distinction?
I don't know if it's very easy or not. It depends on the case, I suppose. But I don't see why it should be more difficult for the seller. And IFRS 15 have very clear that they have to know which is the transaction price from the beginning and what to do when there are changes in the transaction price. So maybe it's not easy in some cases. I don't know. But I suppose it's equally difficult for both sides.
Okay, thanks. Michael?
Sorry. Sorry, is this for the same question?
Yeah, if you want to.
Right. Okay. Sorry, I wasn't listening carefully enough to what mentioned to comment on that. Sorry about that.
The question we dealt with was how to distinguish between changes related to the transaction price and those that are not.
Yes, indeed. And no, absolutely. Now I remember the question. No, that is a challenge, and that's where a lot of judgment, I think, is needed to make that assessment, to make that distinction between what relates to the asset itself and what relates to post-purchase trading, if that's the thing that's impacting the variable consideration. I think it would be a key challenge and would add some complexity, I accept, to it if that was the route that the ISB was to decide to go down.
And another follow-up question here for Araceli, and the question is that has there been any academic research done in this area and in related areas, for example, whether entities in business combination generally estimate variable consideration too high or too low? And if so, is there any indications from research in that case that you know?
Yeah, I don't really know all the research, of course, but I am very aware that there is research on the initial price in a business combination of listed entities. So there are papers on that, but I'm not very sure if there's a lot or about this specific topic in particular. Sorry.
Thanks. Serge first, and then Michael. Serge, please.
Yeah, just to follow up on that question. When we did the post-implementation of IFRS 3, we looked into a few very specific M&A transactions, and it is true, although the way things are presented is not always very clear and transparent, but it is true that you discover a lot of contingent issues that all of a sudden pop up. And then you should follow up on that and see what has happened with that liability or with that variable consideration. Do we expect that there are structuring opportunities there, or that transactions are structured in a certain way? Yeah, undoubtedly, that's most likely.
Yeah. Michael, please.
Actually, there seems to be a problem with my hand. I've been trying to lower my hand and it's not worked. Sorry about that.
Okay, no problem at all. Thanks. I think I saw Michael Fechner wanted to jump in with a question also. We do not ban moderators from asking questions either. So I think I give the floor to you, Michael, to ask your question.
Yeah, my comment was about whether the cash payment should go in one direction or the other, whether it should be only the cash payments made by a purchaser. And my takeaway from IFRS 3 at least is that IFRS 3 explicitly covers both directions, even though it says it's usually the one direction. So in that instance, if we talk about when to recognize a liability for future cash payments that are triggered by future actions, one must then ask what is the criteria for recognizing a receivable that also depend on the purchaser's future actions. And when it then comes, I think just one thought that I want to put out there, if it comes to the intention of the asset, there may also be a question on whether it's not the intention to also receive some money back. So just to put that out there, I don't have the solution. But if we go down that route, or if the ISB goes down that route to develop more guidance, I'm convinced that it should cover both directions.
Okay. Thanks, Michael. So I'm looking around to see if there are any other questions coming in right now. I don't think we have any further questions from the audience right now. So maybe with that, I would like to wrap up this session right now, and I would do that to give each panelist 1 minute to wrap up their thoughts on both questions that we have discussed today, and to give their views on the best way forward, and also on what has been developed in the discussion paper from EFRAG. And with that, I would like to give the floor first to Michael.
Okay, thank you. Well, this is a challenging area that has been, I've found a challenge for many, many years now. So I'm so pleased that there is this discussion paper to focus attention on it. I think it's something that does require judgment in order to assess what the rights and obligations are, what the substance of the transaction is, and determining, as I see it, a distinction between, are we talking about variable consideration that is purely to do with the asset, or are we talking about the activity in which the asset is being used and a risk sharing kind of arrangement that follows?
Thank you very much. And Gary, please, your final comment.
Thanks, Claes. I think maybe just echoing some of what Michael said. I think, the board obviously had this on their agenda. Then there were more, and I do agree, more pressing things, although this is incredibly exciting. And obviously I've been following it for a number of years and have some strong views. I do think the board has relatively more important issues it needs to deal with. That said, I do think the discussion paper and the work done by EFRAG is actually very good. And it's almost, if the board did decide to pick it up, the good news is I don't think they'd have to start from time zero. I think there's some really good stuff in this discussion paper that they could use to hit the ground running if they did want to pick it up at a later point in time. And other than that, just thanks to everyone. It's been enjoyable today.
Thank you very much. And Serge, you have a dual role here, also for being the vice chair.
No, it was
reporting more and a user. But please go ahead, Serge.
Very interesting discussion, and the way I'm looking at it is, I'm as a user focused on invested capital, how much money has been invested in which assets, and how much profit does the entity derive from that, from using that asset. Linked to that is, of course, free cash flows, profitability, net profit that you're able to compare with invested capital, and that should be the direction of travel, developing this project further. Make sure that information is relevant and reliable for users.
Thank you very much. And Araceli.
Yeah, I think, as many people said, this is a challenging issue from the conceptual point of view for the regulators, but it's also mainly challenging from the practitioner's perspective. And I don't think this can be solved by the regulators, because judgment is like it is. So it's not a matter of being solved by the regulator. So it's the practitioners, the auditors, who has the main challenge with this issue. But it has been a pleasure for me to participate in this panel, and I think there are things to do. So, and thank you for the EFRAG for the discussion paper. Very challenging to think about the topic. So thank you very much.
Thank you very much. And Katrina, you get the final word to wrap it up, please.
Thank you, Claes, and thank you to all of my fellow panelists today, because it has been a fantastically interesting discussion. As Gary mentioned, of course, we, in our most recent agenda consultation, we didn't get a mandate from our stakeholders to proceed with the project specifically on variable consideration ahead of what our stakeholders viewed as more pressing topics like the statement of cash flows and intangibles. I would say, however, that all of the work that EFRAG has already done in putting out the discussion paper and the feedback that you will receive, I think will nonetheless be very valuable to us. By the way, not only if, we get a mandate going forward on this specific topic itself, but actually in the meantime, because Certainly quite a bit, I think, of what we discussed today perhaps will come back to us, if and when we start to look at intangibles and potentially some projects, a project or projects come out of that for the board. So I think a lot of what we talked about today, a lot of the pharma examples, the media broadcasting examples, all of the rights that arise from those and potentially where you do get quite a lot of variable consideration, I think could come up and certainly would be something that we may need to directly consider as part of any work on intangibles. There is, of course, an active project on IS 37, so I think some of the thinking work around the definition of liability will naturally feed into that. And as I say, I wouldn't be surprised if at some point going forward the topic itself we hear that it's something that should get back on the active agenda. So thank you very much.
Thank you very much, and I wish to express my great thanks to all the panelists for participating today. And with that, I would like to hand over to Chiara del Prete for the key takeaways of this webinar today. Please, Chiara.
Yes, thank you, and good afternoon to everyone. It has been very, very interesting to listen to this discussion and have flashbacks of the dozens of hours that we spent in TEG discussing over the last 3 years and a half and also. So what emerged today on the first panel on the question of when to recognize a liability for variable consideration, we saw different views on these. Both views were presented that the liability should be recognized when the asset is received and when the action that would trigger the variable consideration has occurred. So in a way, we confirmed today that there is a diversity in practice. There is a need to get some more indication here. But also, there was a view that some types of variability should be recognized as a variability initially, and some only when the trigger event would occur. Now, it was also observed that the framework do help to answer to this question, but to a certain extent, because it links the answer to the definition of practical ability. But the tricky question then it is how to define the practical ability. It's something that requires necessarily judgment, and the judgment comes with costs, including audit costs associated to it. And there was also an interesting debate coming across between, for example, Patrina, that was of the view that every time that in a contract there is a provision and the contract is an exchange transaction, then there should be a presumption that you have an obligation. And then the likelihood plays only a role in terms of measurement. As opposed to Michael, the preparer in our panel, which on the contrary wants more bright lines to say either I have an obligation or I don't have an obligation. So there should be more certainty there. Then coming to the answer from from the public, so from the polling questions, the alternative that was most supported was recognizing a liability when the purchaser obtains control of the asset, unless the purchaser would have a practical ability to avoid taking the action that would trigger the variable consideration. So in a way, the majority were in favor of anticipating the recognition of the liability compared to the moment where the action has really occurred. There was also another idea to look at what type of rights you have acquired, because that can also provide an indication when you have more than one right on what you or of when you actually have an obligation. Then moving on the second panel, on whether and if so when to update the measurement of a cost of an acquired asset. According to the panelists, the current practice depends on what the payment relates to. So if the payment is made before the asset is ready for use, then probably the payment needs to be capitalized. And then if it comes after, probably it is more of a royalty and of a payment, and therefore should be expensed. there was also an interesting observation from Araceli that there was something missing in our discussion paper, meaning that we don't articulate that here there should be a clear link with the adjustment of the value of the asset. So what we are doing in our discussion paper is to discuss not the adjustment of the value of the asset, but we are adjusting the price of the transaction. And this is something that was missing in our discussion paper. I felt it was interesting as a sort of an explicit step that we were somehow missing. And also here we had different views in the panelists on when the cost should be updated. But the discussion was more on the circumstances under which the measurement should be updated rather than should it never or always be updated. And here also the panelists were all supporting alternative 3 to say it depends. So it cannot be always adjusting or never adjusting. It depends. And in particular, the alternative that was preferred was updating the cost to the extent the variable payments are associated with changes in future economic benefits to be derived from the asset. It was also interesting to note that our preparer in the panel had a different view and would have preferred a more clear link to the quality of the asset, because the more far in the time you are, the more you go away from the transaction moment and day one, the more there are other factors that are into play, and not necessarily the quality of the asset at the moment where you purchase that. Now, what does it mean this for the ISB? For the ISB, it means that if and when they start to work on this topic, it can very quickly become a huge project. And this I can testimony personally for the hours that we have spent on this project. And every time for the first at least year, it was like discussing for the first time before we really put the right lines in our thinking. So if the ISB had to start a project, it would be important to get a clear scope, to ring fence this scope to PP&E and intangibles, but also interesting to note that many of the considerations that we are making in this project are also helpful to address some questions that may arise in the intangible projects, such as for the pharma or the broadcasting industry. So all of this is very encouraging from an EFRAG point of view, because that's why we have undertaken this project to try to help and offer something that, irrespective of when the ISB, not immediately, but also after, would have to start some discussions, they have something concrete as a starting point. What can I tell more than this, other than asking to all of you to consider sending comment letters to our paper. It's open for comment until November. So we would really welcome more feedback. And then I think I can express my gratitude to the public for being with us, to our panelists and our moderators, and to Malgorzata, who has presented the paper before us. So with this, I think we can close. Thanks a lot for being with us.
Thanks.
Thank you.
Bye-bye.
Yes, it is.